Only way Fed's going to lower rates is inflation hooks over with some extremity, and only way that's going to happen is with recession. So yeah, hoping for cap rates to come down next year is a little bit of a fool's game, I think. With that, where do we play? So let's put it this way. In geography, we don't play in Asia. So Asia perhaps didn't get much dislocation from office, so that's all I know about Asia. In terms of Europe versus UK, we think Europe's further along in dislocation. So we're more eager to play there sooner. In the US, I do think you need to look at it as a 3-year play in terms of from here on to opportunistically invest. Obviously, logistic in certain segments, the speakers, other panelists also mentioned, is still quite healthy. I'm talking about in terms of opportunity where things can actually be provided to you cheaper. We like high-end retail. We talked about 10-year retail dislocation is probably starting to be time. You know, you can order your Tiffany little gift online, but if you're going to buy some very expensive items right here in the hallways of this hotel, you're going to want to be there. So high-end retail it looks interesting. We actually do like on a selective basis, you know, as something as risky as bridge loan is going to change the dynamics of office over the next 10 years, right? Using New York City as an example, by 2030, if you do not conform to the new energy efficiency rules, you're going to be out of business. And some of those buildings just have to be mulled over, quite a bit in Manhattan Midtown, actually. So we think there's actually tremendous opportunity. If anything, I'll say this, in 2019-20, we actually did some fundraising. That was the hardest time for an investor like us, because we need to be paid. We're a AAA insurance company. We're not going to buy without somebody giving us the right yield level. Everybody's underbidding us, and clients were like, why aren't you putting money to work? Market's hot. As we came into 2021, I think there was a lot of understanding, oops, that's the right way to play. So now we're in a situation where as you mentioned, billionaires are playing this market. Anybody with $1 billion can play the market. I welcome them because they have a lot of money, but do they have the know-how? Because luck put aside, all of us need luck. Okay, investing's equally about skill as it is about luck. So put that aside, then it becomes skill. And in the skill regard, I think what's happening is a lot of the commercial real estate owned by regional banks, as you go to smaller banks, their due diligence, their approach and expertise does weaken. And so the billionaires, I don't know where their skill set lies in the spectrum of skill. We love this kind of market where those that have and haven't not of skill, and we all need luck, becomes the differentiating factor. So Europe, we like it sooner. US, we think you do need to play it 2 to 3 years. And it's not about next year's cap rate, really. That's just kind of a, how do you say, a little gift set. It's not going to do much for you. I think if we're looking for some of the better exits, you're going to have to wait till like 2027.
We feel that across Asia Pac, I think as Luis just touched on, you've seen federal banks pause rate rises as inflation starts to move in the more right direction towards target levels. There's potentially still more rate rises to come, but we think we're getting to the peak of those interest rate cycle. Very similar to the US, potentially a little bit further to go, and probably a little bit further in Europe. But I think globally, what we're envisaging is by the end of 2024, you've got most markets with inflation back in those target levels. And I think what it is, it's beholden then on central banks to effectively create a soft landing that interest rate environment so we don't tip into recession. And I think beyond 2024, what you've then got is potential for softening of monetary policy, which then should actually see a natural correlation between cap rates continuing to sort of drip down. We think that will be slow, and that the indicators we're looking for to trigger that are more around labour markets in relation to employment and wage growth. Our fear is if you start dropping interest rates, especially too early and too quickly, and you've still got strong labour markets, you're going to see that spike in inflation again. So I think where that gets us to over that 5-year period, Jack, is really we see cap rates sort of normalising through 2024 and then slowly tracking down as monetary policy softens really into 2026, but I don't see extreme movements. We do see global risk-free rates really normalising above target inflation level of 2 to 3%. there's probably 100 basis points potentially from where we are now of interest rate pressure to come out of the market, and that probably for us gives the same correlation to movements in cap rates. I think thinking specifically about real estate sectors, the comment was made previously that we may be in a period of structural shift around office markets, not too dissimilar to what we saw over the last 7 to 10 years in retail. Now, what does that do to propensity to continue to invest in office? What does that do in a general portfolio reweighting to play out investor by investor? But we do feel that there is a structural shift coming in office. I would say that's probably less severe in Asian markets, really driven by the fact that you've actually seen the use of office significantly higher in Asian markets than you have in the US and even Europe. I think in the US, clearly coastal cities, which were the gateway trophies of office markets historically, I think are going through a severe shift. Sunbelt markets less so, again, as that use of office changes. So from our perspective, that needs to play through this cycle. Still strong believers in the fundamentals around living and logistics. Again, coming back to Louise's point about demographics, but we do think in this cycle over the next 5 years, those asset classes will outperform. But if you think about the amount of investor focus on those sectors and the amount of operator focuses on those sectors, because that's where capital wants to go, we do think that there is a strong requirement to really think about how you add value and who you partner with and what assets and location inside those sectors to focus on them. So I think if we sort of think about the next 5 years versus really the last 10 years, I would say overarching, the beta play on real estate outperforming is gone. The period of cheap capital driving down cap rates and returns outperforming is gone. So really we think you need to be very selective on sub-markets in regions